Hey everybody, we are going to talk about some Chinese stocks today. I'm joined by Rick Munares, who's one of my favorite Fools, longtime Fool.com contributor. Learned a lot about stocks from him before I was even a Fool.com contributor, so I'm really excited to dive into this. Before we get into it, please take a minute and check out the link you see on your screen, Fool.com/Frankel. Get the top 10 stocks from the Motley Fool, our sponsor. It's the best way to support this work we're doing on YouTube. Again, that is Fool.com/Frankel. So, Rick, before we jump in, there's a lot of reasons for and against investing in Chinese companies as a U.S. citizen. So I'll talk about the one that is on my mind in just a little while, but I'm looking at a lot of these and I see single-digit price to earnings ratios. I see just kind of ridiculously cheap valuation metrics across the board, pretty much. Why are these so cheap?
Yeah. So yeah, I mean that's what I've been asking, and just like I know you're considering you're eyeing buying one. I own three right now, and I know I think the reason why they're so cheap is the reason why we're talking about why are we buying these stocks right now, because again I think just general sentiment. The stateside investors is, hey, wait a minute, we're in a trade war there's trade tensions with China, and it doesn't matter what political party wins in November. Both sides are not happy with China right now. You have a case where, just in general, the Chinese government, they've been very regulatory. We've had on the rule breakers end. I know that we've had video gaming stocks like NetEase was my first recommendation on rule breakers more than 20 years ago. Actually, almost 20 years ago. But yeah, it was a great performer. But again, all of a sudden, if China says, "Hey, internet cafes, we're gonna cut them down. You have to be a certain age to play online games." Any regulation can really hurt you. And we see this happen in different businesses. So it is kind of like a risky market. International investing, as we know, there's great companies out there. There's a whole world out there outside of the U.S. stocks. But China is definitely one of the riskiest because of just the government, the fact that there are trade tensions right now, and just geopolitical tensions, not even trade. There's a lot of things happening. Those are the reasons I think the stocks are cheap as far as historical valuations to them and also relative to other valuations around the world, especially U.S. stocks. But I think that's also the opportunity. Again, if you go in thinking, I'm taking on a lot of risk, I'm not buying a stock 8-9 times earnings if I would a company I know right in my backyard here. If you know that going in, it could be an opportunity.
Yeah, sorry for the dogs behind me, everybody. This is Ash and Ember. They're going to be characters on these videos for a while. We recently adopted two puppies, but so that makes sense. And I don't really want to get into how the election's going to affect Chinese stocks, things like that, because honestly, we don't know. But there are a couple other kind of interesting dynamics with Chinese stocks, especially e-commerce stocks, which is what I'm looking at. China in the U.S. It's no secret that companies like Amazon and Shopify and things like that, their sales went through the roof during the COVID pandemic. A lot of people had no choice but to shop online. That was even more exaggerated in China. They were, remember they were the land of the zero COVID policy. So people were really locked down. So anything in person in China got crushed to a magnitude that we didn't see even in our market. But anything that was kind of a stay-at-home stock really just kind of went through the roof. The one in particular I have on my watch list right now is JD.com. They're trading for about 10 times earnings. The kind of thing that really stood out to me is how aggressively they're buying back stock. JD spent over $2 billion on buybacks in the second quarter alone. That they bought back 4.5% of their outstanding shares in one quarter. That's a very aggressive buyback pace and kind of tells me that management thinks that the stock is ridiculously cheap right now. I'm kind of inclined to agree when I see the numbers and how their efficiency efforts are going. But that's what's on my list. Rick, you said you already own three Chinese stocks. So which ones do you own, and maybe give us your favorite right now?
Yeah, so I mean, again, mine it's so Alibaba is a company that we all know, and it's also a digital commerce play, though very different than JD.com in the fact that Alibaba is more like the namesake side is more like a B2B online marketplace, but they also have Taobao, which is more like more consumer based, Tmall. So they have many different subsidiaries and a lot of stuff going on. But again, the same thing that you're saying, that this is a company that was basically double-digit growth, basically for over a decade, and then the last 2-3 years have been a single-digit growth. And the stock itself, it's been out of favor. It's been down for the last 3 years, so basically declined. Business is still growing, still revenue is still growing, earnings are still growing, but the stock has been out of favor the last 3 years because it's been growing a lot slower. But this year it's actually trading higher. And just as you mentioned, again, it's Alibaba. Some of these companies are buying back stock, and so is Alibaba. But they initiated a dividend late last year. So again, I know there's risk in even a Chinese dividend. It's not like, hey, you're going to get some money back. It's a 2.4% yield right now on a semi-annual payout, but that is there. But again, in Alibaba's case, here's a company that, again, with all the issues happening in China that we discussed earlier, and there's competition too. And this is also hurting, in a sense, I think it's holding back JD.com on your end and Alibaba on my end, that you do have, Temu, which is owned by Pinduoduo, which is like, if you've ever been to Temu, they had a Super Bowl ad this year, so you probably must have, wound up on their site. It's ridiculous prices. I mean, to me, I think that's also hurting Amazon, even on U.S. side, and Shane, I forget how you pronounce it. I mispronounce it all the time. But these are online marketplaces that sell stuff really cheap, and they're reaching out worldwide. So it's not just Chinese players, whereas Alibaba, JD.com, very focused on the Chinese, which is, again, the second most populous country in the planet. They used to be the most populous, now second most populous, huge market there. But to me, again, just like you mentioned, JD, this is also a stock trading for, less than 10 times, 8-9 times next year's earnings, 9-10 times this year's earnings. It's attractively priced for a company that has a clean balance sheet and is doing a lot of things right. To me, it's a very attractively priced stock. And again, I also own some Baidu and a smaller travel company called Tuniu. But for Alibaba, it's my recent buy. I bought in basically right before they reported earnings earlier this month, thinking it was going to be a great report. It wasn't a great report. So yeah, it was sort of uninspiring. But the stock necessarily didn't take a hit because it's so cheap, which is, I think, one benefit. When you buy a stock that's priced for perfection, you need to have a great report. But when you buy a stock that's priced for imperfection, like a lot of these Chinese stocks are, you're perfectly fine when it's just an okay report, which would sort of crush some of the high flyers. So I do think that it is an interesting stock, an interesting value at this point for a company that's a leader. And again, if you're not familiar with Alibaba, before Prime Day happened, or before Amazon Prime Day they created their own holiday, Alibaba did the same thing on November 11th. So basically, they created the Singles Day, and it was just 1-1-1-1. So it's basically a bunch of ones, and it was created like a holiday to celebrate people that are single with a sale. And it's blown up every year. It's like their big selling holiday, off holiday selling holiday, and Amazon pretty much said, hey, I can do that, and they started Prime Day. So Alibaba is definitely an interesting company, a very large company, going through some growing pains because growth is definitely slowing, but very profitable and trying to make the right moves to try to compete with the Temus of the world right now.
I like that pick. It's very Charlie Munger-esque of you to love Alibaba right now. That was I remember that was Charlie's favorite Chinese stock, maybe next to BYD. But I'm really glad you brought up the balance sheet. And I just want to make that point real quick. It's not only that these are trading for like 10 times earnings, whatever like that. A lot of them have cash-rich balance sheets. I know JD.com's no exception. Yeah. They have, I think, $29 billion of cash and equivalents on the balance sheet, so they could keep that buyback pace up if they really wanted to. I know Alibaba's got a very healthy balance sheet as well. So that's a strength too. It's not just that they're 10 times earnings. If you back out the cash positions that they have, it's usually even more. Rick, thanks so much for joining me. Again, leave us any comments you want. I know this is my channel, but I will be happy to relay any questions you might have for Rick. Thanks for listening, and see you next time. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.